I think for us, like we call ourselves like we're not an impact fund, we're a VC fund with impact. And fundamentally, like our impact has always been the belief of like if we can give diverse founders the opportunity to create large companies, then we can close the wealth gap.
Welcome to Venture Voices, where we interview emerging managers within venture capital. I'm Richard Kerby, a partner at Eco Ventures, and today we have the pleasure of having Henri Pierre-Jacques from Harlem Capital. Henri, welcome.
Thanks for having me.
Yeah, no, appreciate you coming through. And everyone's obviously bouncing around the world today. I know you are a big traveler. So, Henri, are you home in Miami, or are you elsewhere in the world today?
I'm home in Miami today. It's been nice to be home for a little bit.
I bet. And I think most folks know Harlem Capital, but I think it's always great to hear from the source. And so, can you just share how you co-founded Harlem Capital, and what inspired you to focus on investing in a broader diversity of entrepreneurs versus what has historically been the status quo, if not the case?
Yeah, so the quick story, so my two partners and I have known each other since 2010, so about 13 years. We did a college program together. And we became roommates and we worked together. And during private equity, we said, hey, why don't we start investing for ourselves, given we were doing deals for our firm. And so we created Harlem Capital as an angel syndicate December of 2013, so roughly 8 years ago. And we started investing in different things. So we were investing in startups, we were investing in real estate properties, we did some private equity deals ourselves. Did that for about 2.5 years between five of us, invested $250,000. Initially we said we'd invest 50K and we actually ended up loving what we were doing. And then fast forward, Jared and I went to Harvard Business School, started recruiting, and we just realized pretty early on we'd worked at a black-owned private equity firm. And most of our angel investments were into diverse founders, even though that actually wasn't like our mission at the time. But we wanted to invest our own capital into our community. That was pretty clear. And so we're at Harvard Business School recruiting, leaving a black-owned PE firm, realizing that there's very few firms in the venture world with black partners. And then particularly because we had invested into so many diverse founders, we wanted a firm with black partners who invested in diverse founders, which there was basically two. And so June of 2018, which was Jared and I's summer between first and second year of school, decided why don't we raise a fund, use the angel track record that we've built the last 3 years, and do what we want to do, which is invest in diverse founders. So that's kind of how it kicked off. It really was by necessity based on what our passions and alignment were and how we were investing personally. But Harlem Capital didn't start with the intention of raising a fund. We loved to invest. We were young, making money, and we wanted to invest ourselves. And then over time, just realized like, hey, there was a clear gap in the market, and felt like we were well positioned to kind of tackle that gap.
Yeah, that's super helpful there. And I think, one thing that I thought about when starting Equal, I think when I talk to other managers, I hear the same thing, is that how do you get the courage and confidence to take that leap? Because, going into it, that means I'm not having income for the entire time period I'm doing this. I may or may not be able to raise a fund. I may then have to go look for a new job again if I fail. And so what led you and your partners to be able to go and say, we think we can go do this and let's go and accomplish it, knowing all the risks that you, Jared, and Brandon had to, overcome?
Yeah, it's funny because like my classmates would ask me out in business school too, and I actually like never thought about a lot of those risks, for better or for worse. I think one, we were 27 when we started, so like we were young and naive. I didn't think about all that stuff. I think two, we were at HBS, right? And so I think ultimately, like if we failed, I felt pretty confident I can get a job. So I wasn't as concerned about that. I think the big risk came when we did our first close. So our first close was 2 million. That was November of 2018. So after the summer. And our target for the fund was 25. So people were like, you're crazy. You got to have at least 30% of your, fund before your first close. But we've been raising for 5 months. We got our first $1 million check from one of the titans in private equity. And I think at that point, we just kind of said, hey, if one of the people who created private equity to give us $1 million, like we have to just go for it, right? And we were recruiting at the time because it was the fall. We only raised 3 million during the summer. And so we were kind of going back and forth. And like after we got that $1 million check, that's when we said we got to do the close. Like let's start doing some deals, build like a track record where we can show LPs that we're leading rounds. We have board seats. So our first deal we closed like 3 weeks after we did the first close. We got a board seat. We led the round, and so we were able to prove pretty quickly, and then use that track record. So then at that point, it's like okay, now no matter what you raise, you're gonna have like manage a fund for some period of time on little income. That's where it kind of started to settle in. And then by the time we graduated, which was June of 19, we'd raised 12.5 million, which was still below our minimum, which was 15. But at that point, right, you're walking across the stage and now like this is it, right? And so, fortunately the next 6 months after we graduated, we raised 40 total. But like crossing that stage, with call it 250K of management fees, there was definitely some concern for us going forward. And Jared was actually getting married that summer. I was already engaged. And so we knew that we definitely had to support our households too. So I think it started to settle in then, but in the beginning, I honestly didn't think a lot about those risks for better or worse.
Yeah, yeah, no. It's definitely nerve-wracking when you're having that first close, but it's so important too, because I think as you alluded to, it means you're in business now, right? You can make investments, you've got a fund, and even though it wasn't a lot, you can kind of pay yourself a little bit. And so it helps ease some of the burden there. Got you there. And then, you know, you obviously co-founded Harlem Capital. You mentioned, private equity before that. I know you were also doing banking before that. Did you ever have like a non-finance related job? Was it like a first Henri job,
No.
when he was in high school or not?
I mean, my first job was like internship was freshman year of college, which was non-finance. I was knowledge management at MetLife, which means I was like basically like helping them to organize all of their like documentation. These massive insurance companies have tons of documents. So there's like a whole group called knowledge management where their whole job is to basically like implement making all these documents fixed so that people can find their documents easily. So I definitely realized I did not like that job. Freshman, I was just like, okay, MetLife, big firm. They were paying me. I didn't work in high school, so I was excited just to get paid. Quickly realized I wanted to do like real finance, and so sophomore year went to Goldman Sachs in the asset management group, and then junior summer of college did banking, equity capital markets at Bank of America. So I've always known for a long time. I started trading stocks in middle school. I started my first business in college. I bought a business in college too, and so like finance is kind of always in my path. I always tell my founders like I can never be like a true operator founder. Like I do think GPs funds do have to have founder mentality, but like the investing side for me has been pretty clear early on in my life. And I kind of give a lot of that credit to my mom. She put me into stock picking classes. When I used to do chores, I would get $5 a week, and if I gave her back $25, she would match that 25. I picked a stock that I would invest in. So like very early on, my mom kind of instilled that finance into me, and she's a doctor. I think she always kind of wished that she knew more about finance from her position. And so that's kind of been my passion for a very long time.
Yeah, no, that makes a ton of sense. And yeah, I know also personally you've been in the game for quite a while because I know it'd be my cousin Ali, and so I've known you for quite a while as a result. And so that was great to see as it's just the evolution from analyst at B of A to running a firm that's got hundreds of $1 million under management. So congrats to you guys as well on that front.
Yeah, it's time comes at you pretty quickly.
And then I think a question like I think LPs in general have is that hey, there are lots of venture funds and new ones are popping up every day, every week, every month. And so, how does Harlem Capital differ from other venture capital firms? What's the unique value that you're providing to your portfolio companies to have a founder say, hey, I'm in a competitive process with Harlem and other firms, but I want to choose to work with Henri, Brandon, and Jared at Harlem?
Yeah, I mean, I think you have to like we check all the like typical boxes of like we'll help you fundraise, we'll do the marketing, we'll help you with finance network. I think we do that better than most funds at our size. But I think really the biggest difference for us, like there's a few things. One, the diverse community, right? So we've invested in 50 plus diverse founders. We do our diverse founder report every year, and like we're always top 5, top 10 in terms of number firms who've invested in the most diverse founders, particularly like at real scale, 1 million plus rounds, not like kind of pre-seed. And so like that like just leads to we have a Slack channel for all of our founders. We have a Harlem Homecoming, which is where we bring all of our founders to meet in person. We do events every quarter. And so for these founders, similar to me, right, at Bank of America, I was the only Black analyst, the only Black banker, period, out of 42 people in my group, right? And it's like you get used to that. And same was true in high school, college, etc. But like it's so different when I went to ICV, which was a Black-owned PE firm, and I had other people around me, particularly who were at the top, right? And the same is true for these founders. Like we have one of our founders who was the largest Black seed round ever done in the whole state of Indiana, right? It's like you're a unicorn in your own way, but like you want to be around other unicorns, right? Like it's not fun to be a unicorn by yourself. And so I think that level of one, you have diverse investors who understand your path. Like us as individuals are unique because very few Black men under 30 have raised $100+ million, right? It's like we understand the weight that we have. And luckily me, Jared, and Brandon have been best friends for 15 years. to share that journey. And so the founders have us to understand empathy, but then they also have each other. And so a lot of them have become friends. They hang out with or without us. They create their own webinars together. And so I think that community is different, and all of us know we can succeed. We've all gone to the top schools, and we've always like been the only one. But it's such a unique experience to have that community around you. And I think secondly, like from a human approach, like one, we're just like young, we're hardworking, like we're super hands-on. We call our founders, we talk to them every month. But it's just like we really understand and empathize with them as humans. And I always tell people, like, if you're going to win a deal, particularly when it was really hot, 21, 22, and deals were getting done in days or weeks, like you can't be selling a founder year after you just met them and do your value add spiel, right? And they have to make a decision in 48 hours. Like that founder has to have some decision or like perception of you before they met you. And then what, when you meet them, that like what you brought to the table is just making their perception reality. Right. And so for us, like that's branding and marketing. So like we do a ton of branding and marketing. We're always posting. We're everywhere. We go to a ton of events. We're on CNBC. We do reports. And so like founders have a perception of us because of what our founders say, because of what we said, because we try to control the narrative. And then when we meet them, you know, in that short period of time, like hopefully we're bringing that reality to effect. But if I'm pitching you for the first time, you've never heard of me, and now I'm trying to give you a deck and say, hey, this is what my firm can offer you, like good luck. It just doesn't work. And it didn't work in private equity. It doesn't work in investment banking. Like people need to know who your bank is before they decide to go public with you, right? Like that's just the reality. And so I think, you know, people can underestimate like the human approach. Like, do I like you as a human? Do I like the things you're tweeting? Right. I'm a church going person. Like one of our founders specifically said, like, I appreciate that like you post about your faith. And that was like a big decision for me. Right. So like if I wasn't like tweeting about my faith, like that founder would have never understood that part of me. And so I do think a lot of VCs oversell their value attribute. I think end of the day, like this is a human to human interaction. And my old boss used to say, like, everything in life's a people's business. Right. And so we're just people who have emotions. And I think that emotional component is really important. And if I don't have that emotional component with a founder, I also won't give an offer, regardless if you have great traction. I need to know I also like you as a human being if I'm going to be working with you for like the next decade.
Yeah, no, I think that makes a ton of sense. And, you know, no one wants to work with an asshole. And so that human element is super
And there's
important,
a lot of them.
particularly, yeah, there's a lot of them, unfortunately, in our industry. And I think particularly where you can't like extract that board member or that investor who you've now found out later on that's not a good fit for you. And so it's a very important decision. As you mentioned in 21 and 22 in particular, like folks didn't have a long time to decide these questions and so forth. And so you were taking a lot of risk on something that's really, really hard to rewind on. And so that human element's really important. And I appreciate the answer there, because I know, at least for, you know, myself and other GPs I talk to, like that differentiation question, I think the NLP asks is like one of the hardest to answer.
Yeah,
it's
hard.
very, very hard to answer because it's very difficult to be tactical and nuanced about it, particularly when it's particularly soft and squishy as the human element piece there as well.
Yeah, I mean, as you said, there's thousands of firms. So like, I mean, you're not gonna be like, you know, you're not gonna be different from every firm. I think it's just that's a false narrative if anybody believes that. But
Agreed.
like all you can say is, you know, look at my portfolio, look at the founders. I think for fund one, that's obviously harder, right? Fund two, it's easier. Fund one, when you're just starting, you have no portfolio. What's your differentiation? That's a critical question to LPs. And that's when it's like really hard because you haven't built your platform, you have no money yet. You know, maybe you have some brand, but not a ton. So yeah, fund one, that was a very stressful question.
And then, yeah, I think it kind of is in the mission of Harlem here, but, you know, can you discuss the impact that Harlem Capital has had on the venture capital industry to date, and on the founders you've invested in as well? And I know, you know, Harlem hasn't been around for a decade or 2 decades yet, but you have made an impact. And so it'd be great to kind of understand how you are viewing that impact today on both the venture side as well as the founder side.
Yeah, I mean, one of our core quotes when we started was, "You can't be what you can't see." Right. And if I think about like the journey of Harlem Capital, like Brandon, Jared, and I met during MLT, which is a diverse program for college students. So we were all in different schools. It brings together 100 to 200 Black Latinos together who want to get into Fortune 500. Right. So that's how we met, is through this program. And then we saw like each other. We like, you're the only Black person you're in your class at Northwestern or at Wharton or whatever. And now like you bring all of them together from across the country. Right. Then when I think about my journey to finance, SEO, which is also another diversity program, is what got me into investment banking. Right. And then I did MLT again to get into Harvard Business School. And so we've always been really fortunate to like get into these top programs for diverse people. And so we've known that like that's a unique perspective. Like we worked at one of like probably a dozen Black owned private equity firms. And so we got to see what does it mean to be a Black person managing billions of dollars, which was a big inspiration for why we started Harlem Capital in the first place. right? So that like quote has stood with us for a long time. And so I think part of that is like why we are so focused on branding, why we do post a lot, because regardless if we invest in you, regardless if we hire you, we know the importance. Like there's going to be a lot of people who don't do MLT SEO, who don't go to a black owned firm, who are never going to have that experience. And so how do we motivate and incentivize to get diverse founders who maybe are at, Facebook or wherever to like take that risk, like, oh, there's somebody out there who looks like me on the funding side. Or there's somebody who wants to get onto the investing side, like, oh, there's somebody out there who's investing. So that's like really the branding side. So we've had an internship program. We've had 18 classes at this point, 100 interns. And so, of the 100 interns, I think 34 now work in venture. And so we kind of have become the MLT for venture capital, which was not planned, but we've seen great benefits from it. And we think it's a great pipeline. And we know ultimately that like Harlem Capital will not be the only, like the sole reason that the face of entrepreneurship changes. We need to have other diverse people be at that firm, even if it's just one Black Latino face at whatever firm. Like if we can be the person to put that one face in that room at that firm, we know that that will help to change the ecosystem. And our fundamental belief is like, hey, if we're market leaders, which we think we are, and the diversity market grows, like we will grow naturally, right? And so like we're also thinking about how do we grow the diversity market, exponentially outside of just the 10 deals that we do a year, right? And so part of that is the brand, part of it is the investment program. We actually just launched a founder launchpad program where we chose 8 people who are operators at top tech firms and they want to start a company within the next 6 to 12 months. So how do we go, like, even though we don't invest that early, how do we go even earlier and help diverse operators think about the structure needed for them to go out and start companies? And like, maybe we'll invest in one of 8. That would be ideal. If we don't, fine, they can go out and start companies and other funds can really back them. So we think about it really holistically. I think we think about it from a diverse market perspective and how do we make sure the tide keeps rising so that we can ride with the tide and not try to go against the tide.
Got it. No, that's super helpful in that respect. And I think one thing I keep hearing across many of these responses is just the brand building and how much you are investing in the building of the Harlem Capital brand. And so I actually wanted to shift quickly to a question I got from one of your LPs. So Hunter over from at Greenspring obviously had asked, how did Harlem do such a great job of building a brand in a very, defined time period versus other funds that have been around for decades and still no one knows who they are. And so obviously I'm sure it was an important focus and it's intentional for you all. And so would love to kind of take Hunter's questions at the next level there and understand, what was the focus there and how you go about doing that.
Yeah, funny. Most people think that we have an agency. It's actually all just in-house for us. I mean, so I think, Brandon and John, who were venture partners, Brandon's not a partner in the firm. When we first started the firm, like they both came from social media, right? So Brandon his social media was Wall Street Paper. He was a men's like suit wear influencer. And then John Henry was really video influencer, more like lifestyle. And so like that was the 2 of the 4 initial partners of the firm were in that world. And so they did really push us to like lean into video, lean into brand. Brandon did our rebrand when we kind of did our whole shift. Like we're dropping the partners. We're just going to be Harlem Capital. He did the logo, the colors, like he pushed us to go that route, right? To buy gear, have the varsity Letterman jackets. And so I give a lot of credit to them because they were in that world. Once they decided to do that, I think us as a firm, we were just realizing that like so many more doors were getting open because of the brand. So like even before we raised the fund, we were getting asked to speak on panels, right? And we were 25 years old writing 15 to 25K checks. And so not a lot of money for us at 25. We're like, we're getting Forbes articles, Black Enterprise article. We're on a panel. Like, why do people care about it? And it was because like we had a website, we had some news articles. And so we realized pretty quickly, like, oh, like you can basically be bigger than what you truly are. And most people thought that we were a fund, even when we were angel investing, because we had the brand, we had business cards, we had a website. And so I think once we realized that, we said, hey, let's double down. Like, let's just like really build this out. We're good at it. We enjoy it. It's opening doors. We've gotten some of our largest LPs through LinkedIn inbound messages because of the brand. And then that just kind of trickles down to the juniors, right? As I typically tweet twice a day, LinkedIn a couple of times a week, try to do interviews every month. Then it's like now my senior associate, Nicole, is passed me on Twitter and she got Forbes 30 under 30. And so I think it just begins to inspire the firm. And not everybody in the firm is going to do it the same amount, right? Even Jared doesn't like doing social media as much as me, same with Gabby. But I think it pushes the firm to do more than they probably would because they're realizing, oh, like look at my teammate getting this opportunity to go to this amazing conference or speak on CNBC because of the brand. And like people want that, right? In the day, like we all want some, like, you may not be an extrovert, but I think people want, people to know what they're doing, regardless if you're an introvert or not. And so I think it's just like once you come from the top and the rest of the firm goods, then it kind of becomes a competition. We actually used to like compete and say, oh, like congratulations, you got to 10,000 or 20,000. Like you make it fun for people, you gamify it, right? And because it is hard, it's a lot of work. Like every morning having to like think of something, like it takes time. Now maybe with ChatGPT it'll be a little easier, but like before ChatGPT, it was just on you and you would spend hours. And so LPs, it's funny because LPs in Fund One thought it was actually a concern. They're like, how do you guys have time? We see that you're so active, right? And I think now it's become a power, and most of our LPs love that we have it. But like, it was not a pro in the beginning. A lot of LPs were super hesitant. It's before 20 Harry Stebbings raised his fund, and media was kind of like in for LPs. And so actually, we had to really push LPs and say, hey, we think this is beneficial. Now we can kind of tell LPs like, hey, we're actually institutionalizing this. And they're really comfortable with that, but they weren't comfortable with that at first. They thought it was kind of a distraction, like focus on doing deals. And we always thought this would get us deals, get us LPs, get us interns, get us in the room, and just kind of complete the circle, the flywheel effect that every VC fund has in their deck.
Yeah. No, I think you guys have done a great job building the brand. So kudos to you all. And I think it also goes back to one of your previous responses, which is the human element. I think founders can see, who Henri, Brandon, Jared, Nicole, Gabby are as humans on Twitter. And I think that's super important. And you want to work with someone that, is a human being, not a machine or robot. And so kudos to your team. And yeah, I'll echo your points on Nicole. I thought she's done a great job. She's prolific on Twitter and does a really good job.
Everybody knows her.
Yeah. And she's done a really great job of just like, I think, promoting and supporting the junior folks in venture. And I think that's super important as you think about the folks that'll hopefully be the Henris and Richards of the future.
Yeah, no, I agree. And it's a great like lane. I think that's important for brand building is like hopefully it doesn't always work out this way, but like hopefully everybody on your team can cover different dynamics, right? And so like all of us are so different. And so like we talk about a lot of different topics. I'm a big math nerd, so I do a lot of like Excel analysis and stuff. And so like, and now Brandon's doing YouTube videos. I don't like doing YouTube videos. And so I think it's really helpful when the team can kind of figure lanes to cover. Right. None of us have gotten on TikTok yet. I think we tried. It's not, it's not going to work for us. We're just not there. But like that is important too when you're brand building is can you create different voices at the firm versus having everybody say the same thing?
Yeah, that makes sense. And, I guess a few seconds ago, you mentioned, venture partners, Brandon and John. Brandon's obviously now a partner. John's no longer, I guess, a venture partner. How have you thought about venture partners in the beginning and how are you thinking about them now? Where do they fit or not fit in within Harlem Capital?
I mean, in the beginning, it was we're raising 25 million. Here's the management fees. There can be two partners. And it was pretty clear, Jared and I, with our PE backgrounds, being at Harvard Business School, like we should be the full-time partners. And Brandon and John still had their social media. They were still making, good money from that. And so they weren't ready to give that up yet either. Right. But the reality is they were co-founders in the firm. We made all of our investment decisions together. And so venture partner was the appropriate title for Fund One, and we kind of paid them a consulting fee, right? Then when it came to Fund Two, we knew we had more fees. We were targeting 100 million. So we said, hey, like this is the kind of the point where you need to decide if you want to be full-time partner or not, right? And obviously Brandon chose to come on full-time, and then John has now raised $20 million plus for his insurance business, and he wanted to go back to being a founder and builder. So really it was kind of like out of necessity for Fund One. I don't know if we'll do that on a go forward basis ever, have the venture partner title, like maybe in the future, like we've thought about doing an EIR or an operating partner. But the venture partner was less of like, hey, we're trying to bring in smart people, and more like these are people who've been around for a long time, but like the pie is the pie. And, who do we think out of the four of us should be running the firm full time? And fortunately, like it was just pretty clear for all of us that it should be Jared and I, and there wasn't any beef, and they were happy to take that venture partner title and continue to do the social media work they were doing on the side.
Got it. Well, that makes sense. And you started mentioning as well how deals are, accomplished or how you get around to saying yes to a deal. So it'd be great to get a sense of how are deals done internally at Harlem? Is there a voting threshold that's required to get a deal done? Is it based on individual GP, conviction, or what's the process to a yes at Harlem Capital?
Yeah, so it's a balance. So we kind of target number of deals per year per partner max, right? And we basically say 60% of those deals max can be single partner conviction. So we have a voting scale 1 to 10. 1 to 4 is negative, 5 to 7 is neutral, and then 8 to 10 is positive, right? And so single partner conviction is you're the only partner that's an 8 plus score. And so only 60% of your deals can be single partner conviction, the other 40%. And so once you hit kind of like your cap for single partner conviction, you can't do another deal again until there's double partner conviction at least. And very rare, I don't think maybe we've had 1 or 2 deals where all 3 partners are positive. I think it's just super rare. So we do understand like it's, not common, but we do like to have some balance. And we actually have gone through, now that we've done 50 deals, and we've looked back at the correlation between scores and like what we rank our deals every year. And that obviously it changes by year, but like generally the top tier stays in the top tier. And our average score for a deal done is a 7.6, right? Average score for a deal not done is like a 6.8. And then we think about like our top performers, the average score is like an 8.1, 8.2. It's like there actually is like pretty good correlation. This isn't true for every firm. Some firms say, hey, when there's like dissent and one person loves and hate it, their companies overperform. Other firms like USB, I know Fred Wilson's mentioned it, their best companies typically have been like some sort of collaboration across the partners. Like that's been kind of true for us, right? So I think the voting mechanism matters most for each firm, and you can't kind of listen to what everybody else is saying. And the more data you have, you can actually go and track and say like, hey, what works for us? Because if we actually found out that like, hey, our single conviction deals are our best performers, then like we would change our voting mechanism. Now, it doesn't mean that like in our top quartile, we do like one of our best performing companies was a single conviction deal that I did. So it doesn't mean that won't happen. It's just more like, what is the correlation? And on average, will those companies that overperform be? And we've just found internally that when actually not even just the partners, because the whole team votes, the partner votes matter, but like we have the team vote because the goal is we just promoted the team. We want the team to become partners. So like if you've never voted before, now your partner, that doesn't make sense to us. Right. And so the whole team votes. So we've actually found there's stronger correlation to team voting than only actually just partner voting. Right. And so we now listen a lot more to the junior on the deal because the junior's doing a lot of the work. Right. And the same was true in private equity. Like as an associate, I ran the deal like from beginning to end, and the boss would kind of do the relationship management, but I was doing all the analysis. Right. And so the team vote does matter. And so we continue to assess it over time. And if things change, like we'll change the voting mechanism. Like we change it from fund 1 to 2 slightly, fund 2 to 3, we may change it slightly. But I think the key is like if you don't have some sort of like data to like reflect on like how is your voting working, then you could just, not really have insights like, okay, what are the things that we should change? What are the thresholds that we should adapt over time? And you can't like what got you to where you are today won't get you to where you want to go. And like that's a fundamental belief for us. And so we'd always rather be right than consistent, right? Like you being consistent sounds great, but like if you're doing something wrong, then you need to change. And so we always rather correct versus like just be consistent.
Yeah, or at least be consistently adapting, and so that way
Yeah,
you feel like you're
consistently evolving.
Yeah, exactly. And I guess to that point, what's the fastest you got into a yes on a deal? What deal was it, and why'd you get to a yes so quickly?
Fastest was probably 36 hours, which was fall of 21, that time period. We knew the founder, David. He used to work at Union Square Ventures. We had known him for 2 or 3 years in the New York ecosystem. We liked what he was building, which was in the Web3 space. Union Square Ventures, another firm, were also already participating. And so it was kind of like one of those like go big or go home investments, right? Super early, but we knew the founder. Valuation was actually like low enough for that time period. And there were good firms around the table. And so we were ready to make a decision we actually had like 3 calls a day within those 24 hours. So we had I remember we had a 2 p.m., a 6 p.m., and then we had a 10 a.m. the next day. So we had a lot of calls, did references. Like luckily the team did a lot of work really quickly late at night, but we got there and got done. I would say our average from initial call to term sheet across both funds to date is 13 days, right? For, in this market, it's probably similar 2 to 3 weeks. So typically it's 2 weeks. We can go like, even in this market today, we can go as fast as a week if we have to. But I think, most deals nowadays, you don't have to. So why would you? But like 2 weeks has been pretty average for us. And it's a mix of like, we've known the founder versus not, right? That one we knew the founder, but even if we don't know the founder, like we can do a deal as fast as 1 to 2 weeks, as long as we do our references, our market analysis, etc.
Got it. And speaking of the founders, I actually spoke to one of your other founders, Ablord, and he kind of praised you guys for having independent conviction. So he wanted to kind of ask, what is something that, you believe in that you think few others also agree with?
I mean, it varies so much by partner, and the Bloider was Jared's deal, but like Jared is definitely more thematic. I'm more of a founder-driven partner, and then Brandon's more operator. Like he loves working with operators, which is why he started the founder launchpad for operators. And so I think by partner it's different. Like for me, the conviction is largely like like the human element is so important for me. I think my greatest strength has always been like I'm a connector. I know a lot of people. I may not be the smartest person in the room, but I'm probably gonna know the most people in the room, and the most people in the room will probably know me. That's like what I'm good at, and so like typically I get a lot of references. Like there was a class at Harvard Business School that I had where they did an assessment of like if you did interviews with your candidates or if you never met the candidate and you did references on the candidate, who typically overperformed, and the references overperform people actually interviewing themselves like individually because there's a lot of bias for that, right? And so I do a lot of references, and because I do have a big network, like typically I know people, particularly in the diverse community, I know people who know you very well personally, like either have dated you, are your best friend, or your boss. Like it's a pretty small ecosystem. And so like I use that a lot for mine on top of like the market research and such. But like I try to assess the people a lot more than probably the rest of the team. And like that is my differentiator and secret sauce. And I'm also just a numbers person, so I can do math really quickly. I love to do a lot of data on them. But Jared and Brandon have different views, and I think that's kind of what we love. Like we didn't choose that; it kind of happened to be that way, and it does work out well that we all have difference, of like what makes us unique from the market.
Yeah, no, that's fair as well. And then I think, as you and I both know, like raising and building a firm is incredibly difficult. And so what are some of the challenges you face, in the first, call it 5 years of the firm here? And what have you learned from those existing challenges?
I mean, it's hard to make money. You learn that real fast. And my old boss told me that he's like, "You sure you want to raise a fund?" Like, he asked me like 5 times. Like, I'm positive. He's like, "It's really hard, right?" And he had like $1.8 billion of AUM, and he still was like, "It's hard." So I think he realized that, right? Like, there's so much that you just will never know until you do it, right? And obviously, people can
Mhm.
tell you like, "Hey, it's not just about doing deals." And now maybe 50% of my job is like actually like doing deals, right? And the rest, like we just got done with the audit. We're preparing for our annual meeting next month, and we had to do taxes in April. Like there's just so much stuff as a GP that you have to do that you just never would have imagined you had to do. Team and promotions and bonuses, and us. We just chose our healthcare benefits last week. Like you're like, what? Why? Right? And so I think that stuff, like I definitely didn't expect. I love it because it really makes you flex muscles and have like such a more better understanding and empathy, honestly, for founders
Mhm.
because like you're doing a lot of that yourself. I didn't appreciate how hard fundraising was. I mean, Fund One was much harder than Fund Two, but like fortunately, like we and Jared love fundraising. Like I do think, for me, like because I'm a networker, like there's no better opportunity than fundraising to meet the smartest people in the world, right? LPs, high net worth individuals, founders who exited who now want to invest. Like there's no other opportunity where like you get to say like, hey, can I talk to you for 30 minutes? Right. And so like me and Jared, like we love fundraising. And so I think we've been fortunate in that because it is probably for a lot of GPs the worst thing that they hate doing. And it's not something that we love necessarily, but it's not something that we hate, right? We like it enough. And so I appreciate that aspect. I think it also gives more empathy to like founders having to raise every 24 months. Like GPs are the same, right? Every 24 to 36 months, like you've got to raise for your next fund. And so I've appreciated that aspect. I mean, I think from like a non-internal team perspective, the challenge has just been like the market environment, right? Like we raised our first fund November 2019. COVID was March of 2020, right? So we were very grateful that we closed the fund before COVID. But now it's like, our first annual meeting was the week after the lockdown. It's like we're calling, fortunately we have a lot of private equity guys around us like TPG and KKR. And so we're calling them and we're asking like, hey, like what did you guys do during the 08, 08, 2000 like recessions? Like how did you, talk to LPs? How did you manage the portfolio? And so that was pretty nerve wracking. Obviously, it was a V-shaped recession, so we came out of it pretty quickly, and then the markets were booming. And then, a year later in March, the Ukraine-Russia war happens, and then a year later this March, SVB happens, right? So every year in March has just been a bad time period. I want to like short March. So I think that's been nerve-wracking for us internally, but honestly more nerve-wracking for our founders, right? Because now founders, like, you get through a period, whether it's the iOS changes, supply chain constraints, interest rates going up, inflation going up, and the next thing happens. Like, you finally got through something, you finally figured it out, and now you got to deal with a banking crisis, right? And so I think like that, like, I feel the weight of my founders on me because I am a human empath. I can feel their emotions, and I think that stress that founders have felt, I never thought that I would feel to the level, right? And when you have to have your founders calling you and they're like, "Hey, I'm firing 30% of my team," like you're going through that emotion with them. And so I think that part, like, you are a therapist slash executive coach to some extent. I didn't appreciate the level of that. And when you've got 50 companies, and me personally 20 plus, like, that's a lot. Right. And so I think that part, a lot of GPs probably underestimate. And part of it is also our style because we are much more human in touch. Like, we do talk to our founders very frequently and like we're pretty close to them. We probably feel that weight more than most. But like I'm okay with that because I want to be, I'd rather be close. I want my founders to be vulnerable and transparent with us rather than kind of feel like it's purely a business relationship.
Yeah, no, I mean that's very on brand for you personally and Harlem as a firm, and so that makes a ton of sense. And yeah, I guess 15 minutes ago or so, you mentioned wanting to continually be evolving and adapting to the market, the ventures and founders, what they're looking for, et cetera. And so, how has Harlem evolved since its founding?
Well, angel syndicate to fund was a big difference because now it's not our money. So that was stressful. I remember our first check was a $250,000 check, and we were so nervous to make that wire because we were investing 25K per seed. So we had 10x the check size, right? And we're like, oh man, that was scary. Then by the time we got done with fund one, we were doing $1 million check, right? And then now in fund two, our biggest check was 3.5 million. So I always tell people, like, you grow at, like, you actually change and grow like as you scale, right? Like, because you have to scale with whatever company or fund you have scaling to. And so now, like, I can't even imagine writing a $250,000 check. We would never do out of fund two, right? So it's kind of crazy to see like the growth of like risk appetite, right? Because doing a $250,000 felt risky, and now like your risk appetite grows as you grow and scale. And I think that is the power of money, right? You can see it with founders. Like, when founders raise their Series A's, like, they change, like the swag changes, like they've got $10 million, and there's just more confidence, right? So that's definitely changed for us. I think the risk appetite, I think it has to in venture. Obviously, with scale comes like bigger team, more infrastructure. So like now we've kind of gone from like best friends for a decade to like, oh, we've got to manage people, who we didn't necessarily know or weren't our friends. We have to do bonuses, and people are going to leave. That's natural, right? We've lost employees too, and deal with that versus like us, like, we know we're tight, we're good, like, we're going to be together forever, regardless of Harlem Capital. So that part definitely changed. And then like the institutionalization of the firm, right? Now that every month we do webinars for our founders, we have this founder retreat, we're doing our first in-person annual meeting this year. Like, all those things just take up so much more time. Where like as a manager, like in the beginning, I was so deal focused, and I still obviously have to focus on that, but like there's just so much other stuff, as I mentioned, and like that's been the evolution for us. And I think whether it's the voting score, whether it's our deal diligence process, like we shortened the diligence process and moved some things around because the pace of deals have gotten faster, and so you may need to like put things in the beginning versus at the end. Like, we used to do a lot of our industry like multiples and like exit scenarios towards the end. Now we do it in the beginning, right? Because we're like, hey, if we can't make money on this business based on multiples and ownership, et cetera, it's not really worth our time to even do the rest. We're switching stuff like that. And so I think it's just like constantly evaluating what's working. And now and today, right, like with AI, we have an AI channel in our Slack, and we're constantly sharing tools. And the key for us is now, like, how do we, like, if you don't think about like how does AI not take your job away in any industry, you're probably going to lose your job. And so like, how do we use AI, not necessarily like to pick deals, but to like become more productive and enhance, right, at the firm. And we told all of our companies this too, like, we don't want you to become an AI company. If you're not AI native, don't become AI. But how do you use AI to become more productive, increase your gross margins, maybe, accelerate, replace people, whatever it may be. And so the same is true for us. And so I think a lot of VC firms are super untech savvy, and they invest in tech companies, which I find really fascinating. And so we've always told ourselves, like, as a firm, we don't want to be a firm that like isn't doing what we're asking of our companies to do, right? So whether that's tech, whether that's infrastructure, whether that's process, whether that's hiring, whether that's diversity metrics, like if we're telling our companies to do it, we're on the boards, like we better be doing that ourselves. And so if we're going to tell our companies like, hey, you need to get more productive using AI, like, then we need to get more productive using AI. And like whether that's with Gmail or emails, or we've now done it for Zapier, and they just released OpenAI Zapier, Like, how do you get your deals to be like more automated, like using AI to like scrub it, right, and put into whatever your CRM system is. That's the kind of stuff we're thinking about now, like in this new world. And so I think it's just like every year, like what's that new thing and how do you continue to evolve the firm so you can like continue to compete?
Yeah, yeah. So I guess, going forward at Harlem Capital, all memos will be written by ChatGPT. All investment decisions will also be determined by OpenAI, and so Henri will now be a figment of our imagination going forward.
That's it.
One thing sticking on this like evolution period is I'm going to go back to another question that Hunter from Stepstone wanted to ask is, how have your thoughts around diversification and portfolio construction changed since, we'll call it not the syndicate, but Fund One Harlem to Fund Two, and where you want to be, going forward?
Yeah, so Fund One, we did 20 deals. Fund Two, we've done 23. Our target's 40 to 45. So I think the first thing was like number of deals, we wanted to do more. We liked having more diversification. We felt like if we can get our minimum ownership threshold in more companies, we're better positioned from like a risk return perspective to return the fund. I think from another point, like we're going deeper on like what diversification means, right? So for Fund One, the stats we used to track pretty heavily was percent of founders that are Black, Latino, percent of founders that are women, like where are they geographically, and then where are they industry wise, right? So we kind of knew that. Fund Two, we're going to a deeper level where we now look at like what is the founder archetype, right? So we have what we consider our four archetypes are stars, veterans, academics, and operators. And so like, how does that diversification operate? We look at age now, right? Our median age in our portfolio is 33. We look at like, what's the age 25 to 30, 30, 35, 35, 50, 50 plus? Like, how does that vary? We're looking at geography and a bunch of other things. So I think like, if we actually have a slide in our LP deck which has diversification. There's basically 10 things, and we show the diversification by stage, round, etc. So I think we're just like getting deeper into that and really trying to figure out like, hey, where's the risk? And that like our view is like we're glad we're not like a thesis driven firm. I think if you were a consumer fintech or Web3, like you would be in real trouble right now. Like we had consumer fintech, we had Web3 in the portfolio, but like because we're diversified, like we have other companies that aren't getting crushed as much in those industries. Right. And so I do think there's power to diversification. I have a very old school Warren Buffett approach to investing, like, and we're going to invest in AI as well. Like we've done one deal so far, but like we, similar to Web3, like it is risky. Like, yes, I do think AI will change the world, but like it's early days, it's '01. Right. And so like we're going to be diversified and make sure like if for some reason like it's another AI bubble, which happened in 2017, that, some percent of the portfolio won't be exposed. So we just think about it in a much more kind of like LP perspective, similar, like, but like, how do we continue to go deeper and deeper? And, there's a balance, right? Because LPs are putting you into a bucket because they're getting diversification. So they don't want you to be too diversified because their portfolio is diverse already, right? So we go back and forth and think about that. And we have open communication for our LPAC and, hey, like, how do you think about this? Like, how do you think about this slide? We haven't got any pushback so far. Like maybe at some point we will, but like, I think as a GP, you also have to understand like, you are diversification already for an LP. And so like they only want you to be so diversified. And like, what's that balance of diversification you should take as a firm that they're taking? Because they have you in a slot, like your early stage, your consumer fintech, whatever it is, like you're in a slot that they need to fill for their portfolio too.
Yeah, no, that's exactly right there. And then as I'm continuing on this, like maybe LP thread here for a second, LPs are always asking us for, how are you providing value to your portfolio? How do you demonstrate value add? And so I actually want to turn the question around and ask, how have LPs provided value add to you and the Harlem team in general?
It varies by type. I mean, it's like Hunter Greenspring is, now Stepstone, the largest fund of funds for venture capital funds, right? So we went to their annual meeting. They had all 80 of their early stage fund managers like pitch to the entire LP community, which was a great opportunity for us and for everybody there. But they also have a ton of data because they have 80 plus funds. They know what their A marks, B marks, time between rounds dilution. And so whenever we're doing our new fund model, like we always go to Greenspring and ask them for data. Hey, like what are you seeing for Series B dilution? What are you seeing? Like how do we want to build our pro rata? How should we think about the Series A? Like what's the conversion between your funds? It's like they've been like fund of funds are great for data because they have data that like traditional pension fund LPs won't have because they're just not in as many funds. Now, like the other side, like for our corporates, whether that's Apple or Bank of America, like they are unique, right? So for our consumer first focused companies, like Apple has like literally had office hours for our companies on like how do you best position yourself in the app store. right? B of A as a bank has given us all of their funds access to their research platform, which is top 3 research platform in the world, right? And so we can get access to any research reports for free, right? So like every LP, which is why similar, like we want to have, like we literally have when we do fundraising, we have an LP map, and we kind of think about like how many fund to funds versus institutions, endowments, corporates, high net worths we want. And some of our best LPs have been GPs of other funds, right? Like Nahal at ENIAC, Josh Kaufman at First Round, who's speaking at our annual meeting next month. Like these are, smaller checks relative to the fund size, but like have been some of the most influential people for us in how we think about strategy. Like Josh Kaufman was a huge reason that we kind of moved towards ownership super early. Like we actually had done 7 deals in the fund where we were doing based on check size. And then Josh, like his biggest regret for early first round was that they didn't do ownership targets, right? And now like everybody talks about ownership, but like this was not a thing a decade ago, right? It was like if you can make 5x, 10x, MOIC on a 500K check, why wouldn't you do that deal? Well, it's because it's $5 million return on a $40 million fund, right? People weren't thinking like that. And so that was a huge inflection point for us. And so I always tell like people like, yes, have your minimum check size, but like some of your best value add investors will be the smaller checks, right? And yes, you want institutions because endowments and pension funds are going to invest you for at least 2 to 3 funds. So you want that stability. But like there is value to certain corporates, there is value to certain fund to funds, and every LP is bringing something different, similar to a startup with boards. Like hopefully your board members and investors are each bringing something different. Like we think about diversification the same way for the LPs, and there's not like just one thing that we're looking for from every LP, because that to us is a waste of space to have every LP giving us the same viewpoint.
Yeah, I mean, you've got them on board, you might as well use them to your advantage. And as you mentioned, if you diversify your LP base, you're going to get diverse ways that folks can be helpful. And so that makes a ton of sense there on that front. And I guess we've talked about ownership a couple of times here, but we actually haven't asked the question, what is the target for Harlem? Where do you want to be and where you are now on that front?
Yeah, so Fund 1, median ownership was 8%, Fund 2 is 10%. Kind of coming up now in this market because we can finally. I mean, I think like, we always tell founders, hey, we want 10 to 15%, right? We can flex some. I think the lowest will probably go as like 7 or 8 if we co-lead or it's a hot deal. But like we always want more. I think our belief as a fund model is buy more up in the beginning. We do our pro rata in almost all of our deals, maintain ownership, and then expect, 40 to 50% dilution from Series A to exit based on historical data that we've seen. And so that's how we think about it. And then, for Fund 3, as we get bigger, like you need more ownership. If you have a bigger fund, you need more ownership, right? And so like we always assess that. And then obviously there's like what you want and what the market will give you, right? And so that's kind of back and forth. And like, yeah, like there's some deals we probably, do we want 15%? Obviously, but like in the deals that we've won, like could we get 15%? Probably not. It's like there's, a bias there, like on like deals we're getting 15%. And so we're cautious of that as well, right? I think in this environment today, you're definitely seeing less co-friendliness between firms because it's just a harder market, right? And people have their ownership targets and exits have come down, so people have to be a lot more strict on those ownership targets than they were in 2021 because now people don't believe the decacorns are nearly as possible as they were 2 years ago, right? And so I think you definitely are seeing that happen. And so as a result, the question becomes like, what's the barrier of like the ownership target versus like having nobody else around the table? And that's a balance. And we think about that too. Like we don't mind having conviction, but similarly, we do have like a bucket of like what were the amount of deals where we were basically the only like real VC fund around the table versus like other VC rounds around the table. And if your whole fund is you're the only VC fund, particularly in this market where most companies are probably going to do C plus or Series A plus, that can really hurt your reserves, right? And so even that for us is like a balance of like, hey, yes, we want conviction, but we'll take the ownership, be the only one. Like the whole portfolio can't be us because you get screwed on reserves, and we've seen that happen for a number of funds around the table. Like they just don't have appropriate reserves, and now founders are getting screwed because like the funds that should have been there to support them aren't supporting them in like tough times.
Yeah, that makes sense here. And I guess switching gears to a completely different topic here, and I don't think that venture itself or tech itself will, solve society's challenges or solve the inequities that we see in the world. But, what role, if any, can, what we do, what our industry is doing play in solving or at least improving some of these challenges that we face on a, unfortunately day-to-day basis?
Yeah, I think too, I think first it's like invest in things that matter, right? That you think can like actually change the world. And it's so easy because like everything's a lot of VCs are sheep, right? Like we're followers. And so whether it's the Web3 bubble, the consumer fintech bubble, the creator economy, now AI, like, there's like always these hot trends. I haven't been in venture that long, but it's been pretty surprising to me like how cheapest the venture industry is. And like we just follow like whatever the theme is, like how that theme becomes a theme, I don't know, Idrissa maybe decided, I don't know. Right. And so I think it's like, how do you continue to invest in things that really are going to impact society? I think for us, like we call ourselves like we're not an impact fund, we're a VC fund with impact. And fundamentally, like our impact has always been the belief of like if we can give diverse founders the opportunity to create large companies, then we can close the wealth gap. Right. And if you look at, there's been a ton of studies done on like closing the wealth gap, right? Like you think about like, oh, college education, people of color working at Google, like that actually doesn't close the wealth gap at all because it's so big, right? Like the wealth gap closes because of equity and ownership, right? People have to own businesses, take them, go public. Their existing, manager teams were diverse, and diverse people hire more diverse people. And like whatever the next PayPal, group is, it's a diverse group that then goes on to create the next Rappi, right? What Rappi's doing for like Latin is like just that's what PayPal did for America, right? And so I think like that has been our fundamental belief is like venture can give ownership to underrepresented groups. And like, yes, there's some level like of elitism to that. Like, I think if you're like, I'm not naive to think like anybody who of color who gets venture capital, like probably isn't, in some unique position relative to the rest of like society. Right. But like it is a start, and it is a start to get people of color and women to get that wealth gap and to get the equity. And if you look at like who are the rich people in the world, like a lot of them, if you're not kind of like oligarchy or own real estate, whatever, like are people who are tech entrepreneurs. Right. And so like my like personal mission is to create the most minority millionaires of all time. And I think that venture capital is the fastest route to create the most minority millionaires. Right. And so I think that to me like is a way. And I think it's yes, like we're helping to make people money, but it's not just about the money. Like it's about what that does like for their family, for their communities. And it kind of goes back to the beginning of the conversation, right? You can't be what you can't see. Like if there's like a black Elon Musk, like what that does for the community is like significant. Right. And so yes, like they're rich and they made money and they have a lot of employees. Hopefully those employees are diverse. Like it also just is inspiring to people who aren't in that world, right? Because like you're in the valley or wherever you are, and now somebody in Detroit, somebody in Haiti, somebody in New York, Brooklyn, Miami, like can see that person because they're on the cover of Forbes, the 30 under 30, right? Like that is very powerful. I think you can't underestimate that. So I do think venture is unique because we have a massive platform, we have a microphone, we're on television, we're on magazines. And if you can use that to help underserved communities become more rich and become wealthy and disperse and also like become visualizations for others, that I think is the impact. And that's what we tell LPs, like, hey, we're not looking to have our founders, like you need to be in certain communities. We don't have impact metrics for our founders. Like you need to hit these certain, because they already have enough issues. Like it's already challenging enough to be a diverse founder raising venture capital. I don't need you to be an impact founder to raise venture capital. But our belief is that if they succeed, this will impact society in ways that maybe, aren't clear on a metric sheet.
Yeah, no, that's helpful there. And you've given us a ton of time, so appreciate that, Henri. And I guess I'll just have one last question here, and which is, what is your goal for Harlem Capital?
I mean, the goal is the mission, which is to change the face of entrepreneurship. Whether that's the founder side, the investor side, the LP side. Like we want to change who's around the table, and we honestly want to create our own table, which is why we started our own firm. I think, for me, besides like creating the most minority millionaires, like I want to create a platform and legacy that will last long behind me. Right. And so you see now the turnover of a lot of people, whether that's Gurley at Benchmark or others, Henry Kravis and George Roberts at KKR, like these are critical times for a lot of firms that started in the 80s and 90s. And like, I want that to be the case for us. I want, Tiger has created a lot of Tiger Cubs. Like I love whether it's our interns or our full-time employees, like go on and start their own things, right? And they can go and be successful. I think, that's a part of the game. It really means that you've built a culture of success. I don't see like employees leaving or starting firms to be like competitive. Like I want them to succeed. I want them to create the next Harlem Capital. So like one of like the joys for me besides investing in founders is like seeing like 30 plus of our interns now work in venture capital and then like telling me like I would have never been able to do this without like Harlem Capital's internship. Like that to me is powerful because I know I'm in finance. I know like what that will do for them. Like that's going to change their life. They're going to be successful, their family, their kids, like it's going to impact them pretty dramatically if they want to stay in that space. And so like that brings me a lot of joy to see that we can create more investors in the space because being an investor is a privilege, is unique. It does set you up for success long term if you want to stay in it. And so I know that's really valuable for a lot of those interns. And I want them to raise a fund and compete with me. Like I'm looking forward to like in 5 years compete. When two of our interns now have their own funds, I'm invested in one of them, right? Like at some point, I would love to compete with one of my interns. Like I think that's just fun. I love competition, and I love that I can help to build more competition for the diverse community.
Yeah, and you can still find ways to collaborate them too. You don't have to be them on deals in that front. But
we can work together sometimes.
No, terrific. I wanted to kind of end on one note. Henri and I share lots of things in common. Obviously, we're both venture capitalists. We're both Black, but probably the most important of all things is that we're also both Haitian. And actually, we're recording this session today on Haitian Flag Day, and so special day for both Henri and I. And thank you, Henri.
No, thank you, my Haitian brother.